Hi everyone, welcome to the first video on this channel. My name is Cedric and I've noticed something interesting about the stock market. Most videos about which ETFs to buy focus on US based ETFs. But if you live in Europe, you've probably noticed that many of these ETFs aren't even available to you due to Europe's regulations. So if you're struggling to figure out which ETFs you can actually buy in Europe, this video is for you. Today we're going deep into a simple diversified 4 ETF strategy built just for European investors. So let's start with the big picture. We're building a diversified portfolio using just 4 ETFs. Each one plays a different role. One gives you global stability, one gives you steady income, one brings you high growth, and one adds that small company upside. And yes, all 4 of these ETFs are available in Europe. By the end of this video, you will see how they fit together like puzzle pieces and create a portfolio that is balanced, global, and built for the long term. All right, so you might be wondering, why not just buy one global ETF like the VBCE ETF that you can see on the screen? Well, that's a very good question. The answer is control and balance. With 4 funds, you can fine-tune your exposure, meaning you decide how much to invest in stability, income, or growth. Today's lineup will be VBCE. This is your global foundation, and this provides broad market exposure for across 3,000 companies worldwide. Then you have TDIV, this is your income source, your dividend paying ETF. Then you have EMEM, this is your growth engine in emerging markets. And then as last but not least, we have the WSML ETF. This is your small cap ETF. This will be an ETF with high growth potential, which institutional investors often overlook. So as you can see, each ETF covers a different part of the market. Together, they make your portfolio stronger and more flexible. So let's deep dive into these ETFs and start with the foundation. The foundation of your portfolio will be the All World ETF, the Vanguard FTSE All World ETF. This invests in all major global markets, and it's very diverse, so to speak. About 60% of it is US-based companies, and it invests in names like you already know, like Apple, Microsoft, and Nvidia. The other 40% comes from Europe and the rest of the world, which gives you a nice broad diversification, unlike if you would just invest in the S&P 500, which only covers US-based companies. So this gives you the global stability and simplicity you want and need. As you can see, the top 10 holdings are already very well-known companies. You can read up about them later as well. Next up, we have the TDIV ETF. This is your dividend ETF. It focuses on companies that pay steady and sustainable dividends. This is perfect if you want to earn cash flow while holding your investments. Here is what makes the TDIV ETF extra interesting for Europeans. Around 65% of it is made up of European companies. This helps balance out your VBCE's heavy US exposure. This is your income engine. It keeps your portfolio stable and rewards you with dividends over time. So even if the holding goes to the downside, you still earn a lot of cash flow by dividends. Dividends are paid out quarterly. But if you want to capture the real growth, of course, of the stock market, we need to look beyond Europe and the US. And that is in the emerging markets. So for the emerging markets, will be talking about the iShares MSCI Emerging Markets ETF. This ETF gives you exposure to the world's fastest growing economies, countries like China, India, and Taiwan. It includes huge global players like TSMC, Tencent, and Samsung, companies driving tech innovation and customer growth. Now, yes, emerging markets are more volatile, but that's the trade-off for higher long-term returns. This ETF helps your portfolio grow faster by adding exposure to economies that are expanding quicker than Europe or the US. So now we have got global exposure, income, and emerging growth covered. Let's finish off strong with a small but powerful addition, which will be your small cap ETF. This will be your iShares MSCI World Small Cap ETF. This ETF focuses on small companies, smaller businesses that are often grow faster than bigger corporations. However, they can be riskier, of course. But over time, small caps have historically delivered higher returns. This ETF includes thousands of small companies from around the world. And yes, a lot of them are from the US, where many innovation startups are born. You may not like it, but it's true. The US is basically the capital of the world when it comes to growth companies, because they have so little regulations. This ETF gives your portfolio that extra growth kick, helping you capture the next generation of market leaders, not just today's tech giants like the Nvidias, the Microsofts, the Apples. Now, before we wrap up, we need to talk about something very important, which are the fees of these ETFs. So you need to pay a yearly fee to basically hold these ETFs. And on screen, you can see the annual fee of these ETFs. These fees can be silent killers of long-term returns, but the good news is that all 4 of these ETFs have super low costs. Here's the breakdown. So for your All World ETF, you pay 0.22% annual fee. For your Dividend ETF, you pay 0.45 annual fee. For your Emerging Markets ETF, you pay 0.40% annual fee. For your Small Cap ETF, you pay 0.39 annual fee. So if you invested 10,000 euro, let's say, in these ETFs, you will only pay around 22 until 45 euro per year in fees. That's nothing compared to actively managed funds that charge 1% or more. Over decades, those savings can really add up, letting you keep more of your returns. So, that being said, are you ready to build your 4 ETF portfolio? Which of these 4 ETFs do you like the most? Let me know in the comments below. And if you found this helpful, don't forget to like this video, subscribe and hit the bell icon, because we will be doing more deep dives into smart, simple investing strategies made for European investors. Thanks for watching, and we will see you in the next one.